Okay, Nilesh Shah, Managing Director of Kotak AMC, joins us now. And Nilesh, good morning. Thank you for joining us. With mutual fund managers and with CEO of AMCs, I only ask one question. Last महीने कितना पैसा आया था? Because that is the talk of the town.
Yes, that is the talk of the town. And as there was a dialogue in Spider-Man movie, with great power comes great responsibility. So we are cognizant of the confidence placed by people in our ability to generate return for them. And clearly we still believe there is long-term growth potential in equity markets in India. But we are also making investors aware that in the short term there could be a consolidation phase, there could be a pause button. If you are overweight equity, if you are part of that minority Indians who are overweight in equity, this is time to book profit. This is not the time to run leverage positions. We are also telling investors this is not the time to listen to all those SMSs which comes to you saying that buy this company and it will go up, buy that company and it will go up. So we are doing all possible in our parts to spread the right message, and we hope and believe that people who are investing on a longer term basis. And one consolation or one comfort factor which we are seeing is that a lot of Indians are now investing via systematic investment plan. There are more than 1.55 crore SIPs running in equity mutual funds, bringing about 5,200 crore last month. So we want responsible money to come in, matured money to come in. We want long-term money to come in, but certainly this is not the market for short-term trade.
Okay. Nilesh, Tanveer, me and Aisha were having a very interesting, conversation which was centered around the excitement in the IPO market. If history is a benchmark to go by, action in IPO market or primary market has always coincided with a market talk. Should we get worried about the kind of subscription and the kind of issues which are now coming up in the primary market?
Nikunj, while I agree with your observation that irrational exuberance in IPO market invariably has resulted into market top. We saw that in 2008, we saw that in 2000, we saw that in 1992 as well. But one big difference between then and today is the goalkeeper SEBI or referee SEBI. In 92, 2000 as well as 2008, a lot of business models which were not real but which were existing on paper kind of got away through the regulators' net to hit the market. But post those experiences, SEBI has tightened the net significantly. Today the debate could be on valuation. Is 30 times for a company good, bad, ugly? Is 20 times better? Certainly there could be debate on valuation, but there is no debate on the business model. Every single company which is coming in the IPO market does have a sustainable business model. Of course, it can get impacted by factors beyond their control, but today when I look at IPO company, I don't have to go and check about their business model in being real. So to that extent, this time top of the market will not be made by quality of IPOs, it might be made by the valuation of IPOs.
And so what do you make of the valuation at which some of these issuances are coming? Because the market is, and the jury is out on that one, Nilesh, that there is not that much left from an upside potential perspective for these issuances, but even so the liquidity rush is so strong that there's a lot of money chasing these ideas.
Undoubtedly, there are certain IPOs where low floating stock is resulting into excessive valuation, and whenever true floating stock will emerge in those businesses or those companies, the market price will rediscover itself. So we are definitely not holding on to those shares where we believe low floating stock has resulted into valuation. Broadly in the whole market also, clearly there is a worry on valuation. Many of the mid-cap companies, many of the small-cap companies, many of the large-cap companies are trading above their historical valuations. In fact, barring 4 sectors, IT, pharma, telecom and public sector bank, majority of sector has stocks trading above their historical valuation. We did some study, and in a very simple way, the conclusion is that the profit after tax as a percentage of GDP has come down from about 7.2% in 2008 to 3% in 2017. Correspondingly, there has been many expenses which have gone up and down, but one significant expense head which has jumped up is salaries and wages, which has moved from 11% to 14%. Now clearly entrepreneurs of India are today believing that it's worth paying higher salaries to employees and retaining them because there is future revival. Had that not been the case, then certainly they would have retrenched people or reduced salaries and restored the profitability. So apart from lower capacity utilization which is impacting margin, apart from overvalued rupee which is impacting exports, apart from higher real interest rates which is hurting small and medium enterprises on profitability, one big driver is the increased salaries and wages as a percentage of sales, and employers or entrepreneurs continuing to pay those salaries does give us confidence that they are all looking at future with hope. They are all looking at rebounds in profitability as operating volume, as operating leverage kicks in with higher volumes during festival season, and once the demonetization and GST effect starts settling down. So yes, we are looking at valuations carefully, but we are hopeful about the future earnings recovery, which has eluded us across the board for last 6 or 8 quarters, which has been patchy in certain segments like automobiles and private banks and NBFCs and chemicals and so on and so forth.
Nilesh, so I mean, what is all this pointing down to? Just this morning, there's a report that's hit our mailboxes from Bank of America, Merrill Lynch, wherein the top guys there are betting on this being just the start of a bull market, and the fact that emerging markets, including India, are going to see the doubling of returns in the next 2 years to come. Would you go with that camp, or would you say that at this juncture, after the rally already playing out, at least in this year, we'll have to keep our return expectations on an index level much more tempered and simmered?
I haven't read that report, but I broadly agree with your statement. I mean, clearly the emerging market includes a wide set of heterogeneous countries. Brazil, Russia, China, South Africa, they trade at a much cheaper level than India. And if there is commodity revival which is witnessed in certain parts, then certainly commodity driven markets like Russia, Brazil, South Africa is a better rebounds. But looking at Indian market, where we have some amount of knowledge, we believe earnings can recover. It will recover as rupee starts correcting, as interest rates start settling down, as operating leverage comes in with higher volume, as employees and wages cost starts getting rationalized. This will result into accelerated profit. This means that the current higher valuations will start getting readjusted. And from a return point of view, as our inflation levels have dropped from double digit to lower single digit, the return expectation also has to come down in nominal terms, if not in real terms. So we do expect Indian equity markets to do better vis-a-vis, let's say, real estate, gold or fixed income. But it's unlikely to deliver return which it has delivered in last 3 years since the new government came to power.
So then sector-wise, Nilesh, we have already seen the underperformers starting to move. Is that the next wave of participation where IT, pharma, I mean pharma, all of this week, the news has been more positive than negative, especially starting off with the likes of Dr. Reddy's, that big brokerage upgrade coming in on Sun Pharma. Is it time that the market starts seeing value in the underperformers?
It's difficult to take that kind of call because there might be some underperformers for a legitimate reason. Within pharma sector, there are companies where balance sheet could be an issue. There are companies where gross block building up could be an issue. So let's not club everything as an underperformer, But yes, broadly the four sectors, IT, pharma, telecom and public sector banks, which are trading way above its historical valuations, does provide an interesting opportunity provided some catalyst works out. In the pharma sector, catalyst has been US FDA approval for factory, US FDA approval for products to be launched in US market, and finally what kind of margin you can get when those products are launched. We have seen one company where they launched a generic product in a product which was going to substitute $300 million turnover product. They were expecting $30 million realization. In reality, when the product got launched, because of severe competition, they could just get $1 million turnover. Now, this kind of thing, even at the end, could come and hurt pharma sector. So we need to be calibrated in our approach. Today, most of the pharma stocks have started moving on because vis-a-vis the market, they look cheaper. If we take into account litigation cost and R&D cost, that's running between 15 to 20% of sales. If that's not going to give them results, they are not going to spend that money. There will be rationalization and hence profitability can be restored. So in pharma sector, you require some catalyst before it can move. The same thing is true about IT, same thing is true about telecom and PSU bank. So don't buy just because they have underperformed, buy because you believe there is a catalyst emerging down the corner.
Now, you may just want to hear us out. Why? Because what we've done is that we've put some data points on what Chandra has so far managed to do with the Tata group. Now, first, he's made a couple of HR changes, new talent, fresh talent. The new CFO of Tata Motors is now is the ex-CEO of HUL. The GE India head Banmali Agrawal is now part of Tata Sons. Aarti Subramaniam, she's part of Tata Group now. Saurabh Agrawal, he was part of AV Birla Group. He's also now part of Tata Sons. So there are a lot of key HR changes Chandra has made at the top. Then he's looking at unlocking and really untangling the cross-holdings Tata group of companies have within groups. So Tata Sons had a holding in Tata Steel had a holding in Tata Sons, Tata Global had a holding in Titan had a holding in Tata Chemicals, Tata Sons had a holding in other small group companies. So he's trying to really unlock them. And then C, which is the most important aspect, he's looking at reducing the number of Tata Group subsidiaries and also looking at really diminishing or breaking down the overlap some subsidiary companies have where they are actually competing in some key businesses. Nilesh, the attempt to fix or reboot the Tata Group, do you think that is something markets are not taking notice of? If I keep TCS, Tata, Titan and Tata Steel aside, not a lot of Tata Group companies have created a lot of shareholder wealth because of poor capital allocation. But can that be history now? And in the next 5-6 years, markets will realize what Chandra is trying to do here?
So market does recognize all the factors at all point of time. All the things which you mentioned are in public domain, and hence I will presume that market has already discounted it. And clearly appropriate capital allocation does result into better businesses and better shareholder value creation. And I just want to narrate one incidence which I am privy of. Ashok Leyland is in automobile business, commercial vehicle business. It had a fairly average history for a long period of time, even though it was duopoly in commercial vehicle sector. And then it started focusing on capital allocation. The management, got revived. They got fresh talent. They started introducing new products. They started streamlining operations. And over a period of time, it transited into a, very well rewarding shareholder story. And there are many such examples in corporate India where through appropriate capital allocation, the shareholder value has been created significantly. And clearly Tata Group in terms of TCS has delivered fantastic return to shareholders. On their governance side, people trust them blindly. So as a shareholder, what we will be looking forward is that what they have done with TCS in terms of creating a $75 billion giant, can they replicate with other group companies? And I have no doubt in my mind that they are in right direction. All the steps taken by, in recent times does give confidence that Tata Group should be part of investors' portfolio.
Nilesh, you may not be able to see this latest innovation of ours, which is called augmented reality. But what we've done is that we've looked at 2007 and 2017. Last time when markets hit an all-time high versus currently when they are at an all-time high. But even the markets may be at an all-time high, the reality is that the performing metrics are very different. In fact, the P multiple in August 2017 or September 2017 now is lower than what it was in December 2017. Market cap versus GDP ratio still nearing 1 but not above 1. Last 3 years markets have been flat. They've not given you a very positive return. And then if I look at the earnings potential, in December 2009 the GDP growth was nearing 10%, right now we are at about 5.6. So valuations are low, market cap versus GDP ratio is still not at an alarming level, and in 2007 we peaked out with the market rise. Currently markets may be at an all-time high, but the earnings cycle is yet to start.
Undoubtedly, in very simple terms, if I have to put, right now we are going through a Samudra Manthan where government has declared a war on parallel economy. Our country, though based in Asia, has tax compliance standards applicable to African nations, and the government is trying to move us from Africa to Asia. And hence in this Samudra Manthan, in the near term, courtesy demonetization, courtesy GST, courtesy shell companies getting removed, courtesy black economy getting tracked through technology, a lot of poison is coming out, and that's reflected in slower GDP growth, that's reflected in poor earnings growth. It's also compounded by confidence of foreigners on our economy, which is reflected in form of FDI and FII flows, and hence rupee is bit overvalued. RBI is also targeting inflation, and hence it is keeping interest rates little bit elevated. So we are seeing the poisonous effect of this Samudra Manthan in lower earnings, lower growth. But with this churn, eventually Amrit will come. That's when interest rates will be fair or equilibrium between borrowers and lenders. Currency will be near its fair value, and tax compliance standards would have improved. There will be financialization of Indian economy, where instead of black money getting parked in real estate and gold, will go into bank deposits, mutual fund, insurance company, and we will allocate it to those entrepreneurs who are creating value rather than who are building their own fortune. This will also result into better growths. This will result into better infrastructure development. So clearly market today is looking for the Amrit coming out of this churn eventually, and it is holding on at current level. In 2007, Fed was cutting interest rates, pumping liquidity. In 2017, Fed is raising interest rates and taking out liquidity. Despite that, our market is at 32,000. In 2007, we had seen capex cycle at the peak. In 2017, we are seeing capex cycle at the bottom. In 2007, interest rates were on the rise to contain overheated economy. Today we are talking about cutting interest rates to support growth. So there is a significant difference between what was prevailing in 2007 versus 2017, and our hope remains that there will be Amrut at the end of this churn.
You know, this morning, Nilesh, it's all about insurance with the ICICI Lombard IPO opening, and just some data points here, and this is according to IRDA, the kind of premiums that we're currently sitting on, and the individual premiums were up by about 20%, and that's on a total basis in the month of August. You had SBI Life's premium growth accelerate to 51% versus 40% in the last month. ICICI Pru Life grew by about 14% versus about 19% in the previous month. And the premium growth at Birla Sun Life picked up to about 25% from the earlier 14% in just the last month. Is it a blind bet right now, betting on insurance, considering the kind of quality paper, Nilesh, that is going to hit the market? Not just ICICI Pru, which is already there, but you've got ICICI Lombard today and SBI Life as well coming up soon.
So my recommendation will be that yes, looking at the insurance penetration in life, general, health, clearly there is stupendous growth opportunity for insurance industry. But at the same time, at the end of the day, you need to be stock specific. Pick up those companies where valuations are in your favor, where business models are in support for long-term growth. All these are great insurance companies, no doubt about it. All of them will get lifted by the rising tide, no doubt about it. But we have seen in IT sector where Infosys and Mastek got listed on the same day. They were both in information technology business, and both of them have done far better than Sensex, but still the difference between Infosys and Mastek is very, very wide. So insurance sector per se looks good, but you can't, just pick up the insurance sector. You have to pick up the right stock within insurance sector to make money.
Nilesh, we'll let you go at that. Thanks very much for being a part of our programming this morning with the Rise with India theme and talking about everything that has to do with the mutual fund industry and the markets at large, giving us your perspective. It's always a pleasure to speak with you.